It's trying to sell off its financial assets to some third party entity, which actually is called as a special purpose vehicle. This special purpose vehicle is purchasing the various financial assets of a company and using this as the base, it is creating and issuing different securities to the market. So it is creating bonds based on the cash flows that are coming out of this financial asset and issuing the bonds in the market. So in a way, what is happening is the bonds that are issued by the SPV, they are fetching the cash for the SPV from various investors, who in turn is paying that cash to this entity and purchasing the financial assets of this entity. This is the overall process that is going in case of securitization. So any financial assets. So generally, probably if I am talking about this as a bank which has issued so many loans to the customers. It could be vehicle loans, it could be mortgage based loans, or it could be student loans, it could be any other loans. So this bank might have given different loans to different participants. So which means all the loans will actually become the assets of this particular bank. In some cases, even it might have given credit cards. It might so the credit card receivables also could be another asset of the bank. Now there could be an SPV, another legal entity, which would be purchasing all these financial assets of this bank, and using that fund it issues securities. So it is using the fund that is got from the securities from the market, using it to purchase the financial assets. So using that asset as the backup, where the purchased assets, which is the pool of loans generally, so that is used as a backup for making the payments to the bond investors. So why is this concept come into picture? Now, if I look at from a bank's perspective, it has given a lot of loans, and these loans would be paid at different points in time. The principal and the interest repayments may happen at different points in time. Until that point in time, the bank's assets are completely illiquid, right? Because generally in all these cases, the bank would have kept the vehicle as a collateral. In case of vehicle loans, it must have kept the building as a collateral. In case of mortgage backed loans, all these are illiquid assets, and until the borrowers keep paying. In some cases there could be a 5-year payment period, it can go to 20 years, or it could be even a 30-year payment period. So the borrowers keep paying the interest and the principal at regular periods of time. Until that particular point in time, the assets are illiquid, and probably the bank has to wait until it receives the cash flows. Whereas now when it has sold, there is again a ready cash that has come into the bank, which means it can actually give more and more new loans. That's one motive behind this entire securitization. And on the second case, the cost, let's say for this bank, if it wants new capital, and it wants to raise capital from the market, it would be pretty expensive, because it's a fresh debt kind of thing that has been raised. Whereas in this mechanism, it's like selling the existing assets to the third party, which means it's a kind of collateralized kind of a borrowing that it is doing. These financial assets are acting as a collateral for raising money. So because the collateral is very strong, the cost of raising funds become lesser and lesser. So that's one of the prime reasons. So in a net, I could see the major motivation for securitization is the conversion of illiquid assets to liquid, and the second thing being the cost of funding, it can quite comfortably be reduced. So with this as a base, the securitization industry has flourished quite heavily in the last 1 decade. So any kind of loans can be securitized. Most commonly, I see the mortgages being securitized, and whenever these mortgages are securitized, and any SPV that has purchased these mortgages and issued the bonds or any other securities based on them, we call them as mortgage backed securities, MBS, mortgage backed securities. And if the same stuff has been performed with respect to any other assets apart from mortgages, the same logic, SPV has purchased those assets, and using that as the base, if the bonds have been issued, we call them as ABS, asset backed securities. Now because of these, what is happening in a general banking system, right? Let's try to understand the general banking system. The depositors, regular customers, they are depositing their money into the bank, different kinds of deposits for which they get different kinds of interest rates. Sometimes it could be majorly it's a fixed or a little bit of floating. In turn, the banks are using this fund, whatever got through various deposits or sometimes through some borrowings. The fund that has come into the bank, it is getting used to issue the loans, different kinds of loans. It could be an automobile based loans, it could be mortgage based loans, or it could be student loans, it could be agricultural loans. I can think of many kinds of loan which the bank is issuing. Now, these people's money who have deposited is being used by the bank to lend. So these people, they are getting almost a fixed rate of return and are not getting a direct exposure to the bank's loans. Right? They are not becoming a direct lenders. The bank is taking the risk in this process in terms of lending. But from the depositor's perspective, there is a lot of safety. They are not getting a direct exposure to this, which means they are not taking any risk, so they can't get a higher return because they are not taking any kind of a risk. Now this securitization is actually bridging the relationship between the lenders and the borrowers directly. Right? And because of this, the risk, instead of the bank taking the risk here, it is transferring the risk from the directly to the lenders itself. So the lender, it is acting as an intermediary in the process between the borrowers and the lenders. And because of this, for the lenders, the cost of lending, they are going to get a much better return because they are going to take a slightly higher risk in the process. And from the borrower's perspective, the cost is going to be much lesser because one layer is completely removed off. So intermediation costs, because now the bank is no more taking the risk, it's only doing the facilitation kind of a role. And because of this facilitation role, the intermediation costs or the intermediary costs are typically going down, which is resulting in overall lenders getting a slightly higher rate of return and borrowers getting it for a slightly lesser cost. And even if you look at it from the other perspective, whatever the loans that are being sold to the SPV, and that is what is being invested by the different investors through purchasing the bonds. They have a direct access on these loans. In case the company is not doing well, in case the bank's ratings have gone down, or bank is going into a default or any other stuff, these people, instead of having a general claim on all the assets of the firm, they have specific claim on all these loans, the financial assets which have been securitized. So that's a much better seniority that is coming as a part of their settlement process. And these bonds, they are actively traded in the secondary market. That's one more benefit that can come. The liquidity is getting increased quite drastically. And because the bank is receiving the proceeds much before the payment of the interest and the principal, the bank is getting more money so that it can lend more. The volume and the growth of the business is much higher for the bank in this particular case. And these bonds, they can be structured. Probably the SPV could structure the bonds depending of different maturities, of different coupon payments, of different priority in terms of the payment. It could very well be structured to suit the investment needs of different kinds of investors. So which means a better matching is coming, a better availability of the sources of funding is coming. All these things, rather than just looking at a fixed deposit or any other regular saving deposits with the bank, new avenues are coming up which are creating the required amount of exposure to the loan portfolios of the bank. So on one side, it can even act as a diversification, because you can very well plan out how much risk you want to take, and based on the additional risk which you are willing to take, you can structure the type of bonds accordingly, because this structure will provide bonds of different maturities, different coupon structures, and different priorities in terms of payment. So rather than directly purchasing the loans, going through an SPV route and purchasing the bonds that are issued by the SPV will definitely create a much diversification and a risk reduction for the investor. So just to quickly understand the various processes as a part of the summarization, I will take a case of a bank which has issued the loans, right? Probably it has given different kinds of loans to different borrowers. So all those loans become the assets of the bank, right? Now this bank has sold all these assets to an SPV. Now this SPV might have been created by the bank itself. The assets are removed from the balance sheet. From the balance sheet, these assets are removed and are transferred to this SPV. Now for the SPV, that assets, whatever it had, it uses those assets as a base, and it actually issues the bonds in the capital market, right? And so in this case, the bank is called as the originator, whereas the SPV in this case is actually the issuer of the asset-backed securities, or sometimes we call it as the trust. They are doing this process, and this SPV, as a word itself, is special purpose vehicle. So this is created exclusively for purchasing the loans from the bank and issuing bonds out of that assets. So it's purely, its purpose is only for that much. And it has created the bonds which are called as asset-backed securities and sold them to the investors. And depending on the payments that the borrowers are making,